In this video, the simplest method of day trading cryptocurrency with finding entries and exits for your trades. I'm going to go through this entire setup right here and how to actually enter orders to make sure that your risk management is on point. I will leave timestamps to everything down in the description. Let's come over to Bybit and get our trading chart set up. If you're not with Bybit yet, I'll leave a link in the description. They give a deposit bonus up to $4,000 if you're new. So if you want to go ahead and trade with me on there, check that link for those details for a deposit bonus when you're trading. And now we need to get our chart set up. So I'm going to come over to derivatives because I'm day trading here. That's what we want to use when we are day trading. Now, if you're a total beginner, you can definitely get set up in the spot market. You're not taking any leverage there. You're not have any liquidations. You just buy and sell with your own money. And that's really great if you do want to, just start off without any craziness going on. Derivatives, though, if you manage them properly, are better because they're a cheaper trading fee option. And also you just get some much better day trading tools. So I'm going to come into derivatives and then I'm going to actually look at this altcoin right here, which is Matic to trade. It's got a great trade setup for me over the last kind of 6-8 months or so. So what we can do right now, once we get the chart right here, is just look around on the lower and higher time frame. So I'm on the 1-day chart right here, which is great just to see a longer term trend. You can also look out to the 1 week, just right click and reset the chart to get it up. And what you really want to see here is just looking for either downtrends or uptrends. And so we're going to go to the left-hand side in the brush. You can definitely see we went in an uptrend right until kind of the crypto market went into a new bear phase, and then we had this kind of big downtrend here. But what we can see from about the 20th of June 2022 is you can definitely see a kind of bottom here. So that bottom formed and there was a big support line there that just drew the price back up. And then we kind of met this consolidation and support and resistance lines, which I'm going to set up in a second for you to teach you how to do that. So we're definitely off of this downtrend here and we've bounced up and we look to be consolidating. So that gives me a longer term trend to look at, to think we're probably within an uptrend or a consolidation, and then we can actually use that, go into the lower time frames. So I'm going to look at the day chart right here to see this. And then when we want to make our entries, we may go over to the 4-hour or 1-hour charts, especially if we're day trading. 1 and 4-hour charts are going to be a lot better for us. But once we've got that set up and we've got in our mind that we are actually probably looking at a consolidation or an uptrend forming here, we can then put support and resistance on the charts. Support and resistance lines are incredibly simple, but the price often meets price support at these levels, known as market structure. So what we can go to do is on the left-hand side, just click this option, but click the arrow to bring out the trend lines tool, and then actually choose horizontal ray. This is something you can choose, so just press this, and now we want to find these areas of support and resistance on the chart. I'm just going to flip to the brush here, and as we can see, after this, kind of on the week chart, we saw this rejection of the downtrend and a big rally. Now we're seeing areas where the price is meeting some support and resistance. So you can see we meet in support and resistance right here. This is a resistance line because we're coming up into this and we're getting rejected off this a few times. Down, down, and down. So that is a resistance. Now, as the price comes down, you can see it meets some sort of price support at this level. You can see a few times the price actually moves down into this price range and it meets support and doesn't go below there. So you see kind of a rejection to the upside here. So that's obviously support moving us back up. You see moving us back up here and then moving us back up here. So this area, this price level in general, would be a support line supporting the price. So we can go over to our trend line tool, and around this level, you can see many touches around this price level. So that's where my line goes. It is resistance if the price is below, and then it turns into support if the price is above and comes down to meet. So that's a key level, and you can see the price here is on the right hand side around 74.75 cents, and then to the upside you see a major resistance level right here. So we have one touch and a rejection. We also have this, which is a bit crazy. And then we have this right here where we get a little bit of rejection as well. So that is a resistance level. Up at this level where you get this crazy price where the price moved up and then got rejection, you would put that as a resistance level as well. And then even upwards, if you want to go further up on the chart, you again can see a huge area where when the price was coming down, it met quite a lot of support at this level. So what we would do there is just draw this line here as well at $1.45 as an area of support and resistance. Now you can see the price often goes and trades to these lines. We got a resistance level here that we got, a lot of support here, a lot of support here again, and then we actually got a little bit of resistance here. So we can use these price levels when we're trading to set our entries, exits, and stop losses. A simple way to understand the momentum of a chart is the MACD. So the MACD gives us moving average, convergence, divergence. It takes a couple of moving averages, and then it essentially gives us a momentum indicator. When we are down here, these two lines, that's oversold, bearish momentum. So what we want to be looking for essentially is for the MACD just to be moving from a bearish into a bullish momentum if we're going to be trading long. So what we want to look at is these crosses over the midline. This is from bearish to bullish momentum. You have, less relevant one here, but it's definitely there. A cross from bearish to bullish momentum. You can see that when you cross over, you often carry on further. You don't just stop at the midline, but you actually carry on. So that bullish momentum continues and it goes into the kind of overbought level. So you can see that a third time here where we're in the bearish part of the MACD, and then we're moving through and then into the bullish part. So as it's a momentum indicator, what we want to do is use MACD to essentially see where we're moving from bearish into bullish momentum with the price. And as long as they both give us that signal, then we can kind of carry on and trade the momentum in the chart to the upside, especially when you're day trading. What you're really trying to do is just get in at a good level and then ride that momentum up to the next price level where you think the price actually may trade to. Now the trade entry, which is the most important part, and how to manage your risk. When taking a position, we can look at the potential risk reward that we're happy with by using something on Bybit right here, which is the long position calculator in this instance. So click on long position. Now we can choose any of these instances to trade. Let's say we're trading this latest move into support with bullish price action. So we can enter around this level anywhere we want. We can either trade the move into the support or when we actually bounce a little bit away from that support as well. So let's just click here, and now we have a trade calculator where we can see exactly how much we want to risk. Where should a stop loss go? Just look at previous levels where you think at this specific price level, my trade would be invalidated. I would choose something like this around the 67 level. As you can see, that stop loss right here would invalidate me, because if the price moved lower still, then it would invalidate the long trade because we actually broke through that resistance, and that just coincides with a cluster right here. So you can move this down a little bit further if you want to give the trade a little bit more room to breathe. Whereas the take profit, again with support and resistance, if you're trading the support right here expecting a bounce with bullish momentum, then you would take profits around the previous resistance levels, because we had 1, 2, and 3 instances where we broke through. Now, if you are a position trader or you want to trade longer term, or you just think Matic is a good investment, then you don't take profits. You just kind of buy at these levels and maybe move it up to somewhere else. But if you're day trading, we need a specific price target that can be hit. So that is our probably price target right here, moving it up to the resistance, moving the stop loss somewhere that you would consider the trade has broken down if it gets there. And then we can see if we are happy with this potential risk reward scenario. How do we input the trade and how big should the trade actually be? We can work this out via how large the stop loss is, what we think our maximum loss is, and that can tell us exactly how big the trade is. So we can use a very simple trade calculation of, let's call it 2%. Usually traders will advise to risk around 2% of your portfolio per trade. If you're really confident about a trade, why not use more, maybe 5% or something? But for the most part, 2% or 3% is where traders will make most of their calculations. So we can therefore work out how much of our portfolio we want to actually put at risk. So if we've got a $1,000 portfolio, you would put $20 at risk. So what we do is take $20 and we divide it by the stop loss amount. And as you can see, we can actually use a calculator as well, but we can see the stop loss amount from the indicator that we've given. The stop loss amount is 0.0835 coins. So let's just call it 0.08. And then what we can do is take $20, divide it by 0.08, and that gives the trade size. What you can also do is just use a trade size calculator. You can use a Bitcoin calculator because all you need is just the actual calculator itself. So you have the open price here, which we've seen is 77 cents from this entry. And then the stop loss was 69 cents. Our account balance is 1,000 and we want to risk 2%. You can see the calculation comes out at a trade size of 250 units. So 250 units right here, we can do the trade entry level, which was 77 cents. And then the order quantity was 250 units of Matic. So we can do that easily. You can see now that we can actually put the stop loss in. So if you just click this button, buy long with TPSL, we can actually come down and put the stop loss in, which we can see was 69 cents. So we can put that in. Now, when we enter this position, so we just press open long, the system will enter a couple of different positions. It will go long at this price level, as long as the price is there. It isn't there now. This is an example, and it will enter the buy order at this price with this amount of coins, but it would also enter a sell order, a stop sell order at 69 cents as a stop loss. So you get all of those positions in. And once those positions are in, they're down here and you can alter them as you want. But we can see right now that the cost of this order is going to cost us $192. But what happens if we have other trades open, or we just want to keep most of our assets off the exchange, or we just want to have some dry powder left over from other trades that are going on? We might not want to use this entire amount. Well, the way that leverage works is that you just put less down. So you don't use the same trade size and use leverage to make your orders bigger, but you just put less of your account on the line each time that you trade. And so what we can do is go to isolated margin and then change that to, let's say, 5x, and just press confirm. Now you'll see on the right hand side, the cost of this order before was $192, but if you press confirm now, the cost of this order now goes down to $38. So what we're doing is opening the exact same trade size that we had before, but instead of putting down almost $200 to trade, we're now putting down $38 to trade. Our stop loss is the exact same amount though, because we put those price levels in and the sell orders in. What you absolutely must make sure of is that you're not using more leverage than to make your cost below your stop loss level. What I mean by that is, if the cost of the order was, let's say, $10, your liquidation price would actually be $10, because this system will never let you go into a bad debt. And so if the cost is $10, then obviously you have $10 in, and as soon as the price wipes out that $10, your trade is completely wrecked and the system will trade you out. And so with $38, we know that our $20 stop loss is fine because it's within the cost of this order. So we're not going to get stopped out or liquidated before our actual trade stop loss takes place. So that is how to responsibly use leverage instead of just making your trades larger. Leverage isn't for beginners though, so definitely go into it with eyes open. I've got some other very in-depth videos about using leverage and how that works in the Crypto Investor course. You can see this futures section that I made. Lots of videos here, step by step through the entire futures trading, how to do it and how to actually put in proper stop losses and how to manage leverage. So if you want to find out more, that link is down in the description to the Crypto Investor course. Trading support and resistance can work very well, but it's more important to manage your stop loss levels and the amount of risk you're taking per trade, as I just showed you. The reason being, even if you have a 50% plus win rate, there is still a 97% chance that you will get 6 consecutive losing trades in a row. And so if you're taking 20% risk per trade, then your entire account would be wiped out from this amount of consecutive losses, which statistically are quite likely to happen throughout your trading career. So with any strategy that you have, you just need to manage that risk, which is the main thing. And using leverage can be done without increasing the amount of risk that you're taking. And the Bybit link to a deposit bonus down in the description as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.